Hello, everyone. Welcome to the Capital Intelligence Channel. Today, we're bringing you an essential explainer that completely decodes the rapidly shifting power dynamics between institutional powerhouses and everyday retail investors. We are going to cut right through the noise to deliver high-value insights for people serious about finance and investing. Because the truth is, the traditional rules of the market, they've been completely rewritten over the past few years, and you need to know exactly how. Before we really get into the data, I want to anchor us with a warning from Warren Buffett, straight from his 2004 Berkshire Hathaway letter. He pointed out that high costs, chasing fads, and a start-and-stop approach are the ultimate enemies of wealth building. Now, what's truly wild here is how perfectly Buffett's warning predicts the exact traps that catch investors today. Sure, the technology has evolved, but the psychological pitfalls, they haven't changed one bit. If you're serious about building lasting wealth, avoiding these three enemies is absolutely crucial.
So here's our roadmap for today's explainer. First, smart versus dumb money. Second, the retail revolution anomaly. Third, the institutional playbook for 2026. Then the social sentiment arms race. And finally, strategies for serious investors. Let's jump right in.
Section 1. Smart versus dumb money. For decades, the financial markets have really just been categorized into two distinct camps, the professionals and the amateurs. When you look at it, the disparities between these two camps are just vast. On one side, you have retail traders. We're talking about individuals managing their personal accounts with limited capital, who often lean heavily on basic technical analysis or whatever the current public sentiment is, usually with a pretty short time horizon. On the flip side, you've got the institutional smart money. These are the massive hedge funds, mutual funds, and central banks. They are capital rich, literally enough money to move the markets themselves. They use advanced fundamental analysis, exclusive proprietary data, and they maintain a relentless long-term focus. Historically, this asymmetrical warfare heavily favored the institutions.
But, as we all know, history doesn't always move in a straight line, which brings us to Section 2, the retail revolution anomaly.
The event that completely shattered the illusion of untouchable institutional dominance was, of course, the 2021 GameStop short squeeze. The mechanics here were just unprecedented. You had professional hedge funds heavily shorting a struggling video game retailer. But then, everyday retail investors united on platforms like Reddit, and they triggered a massive, coordinated wave of panic buying. This collective retail power actually drove an astronomical 1,500% surge in the stock price in just 2 weeks. For the first time ever, the dumb money forced the smart money to cover their positions, causing billions in institutional losses. It proved that in our digital age, organized retail investors can actually break institutional arbitrage. But look, the smart money didn't just pack up and go home. They adapted. Section 3, the institutional playbook for 2026.
We're pulling some fascinating hard data directly from the Natixis 2026 Institutional Outlook Survey here. They talked to over 500 institutional investors globally. The absolute standout takeaway: a staggering 74% of these professionals believe the markets are due for a major correction in 2026. And their biggest fears aren't just about another tech bubble popping. They are deeply concerned about completely unfamiliar macroeconomic scenarios, massive government debt, and sudden geopolitical shocks. Put simply, the biggest players in the world are actively bracing for turbulence.
So how are they positioning their capital to survive this? Well, the traditional 60-40 portfolio of stocks and bonds is getting aggressively thrown out the window. Now, 65% of institutions project that a 60-20-20 model is going to outperform. That's 60% equities, 20% fixed income, and a huge 20% carved out entirely for alternative assets. Because of sticky inflation and all this shifting volatility, hedge funds are relying heavily on private equity, private debt, and infrastructure to generate alpha and cushion the blow from the public markets. And it's not just what they're buying, it's where. We are seeing a massive geographic shift happening right now. After this huge run-up in U.S. tech valuations, the smart money is looking elsewhere for durable value. In fact, 76% of institutions plan to just maintain or actually reduce their allocations to U.S. equities. Instead, they're turning their sights abroad. 90% are planning to maintain or increase their exposure to the Asia-Pacific region, and 88% are doing the exact same for European stocks. That's a massive flashing signal for where the pros see actual value in the coming years. Now, this next part is perhaps the most fascinating evolution of all. Section 4, the social sentiment arms race. Data from the FINRA Investor Education Foundation completely wrecks the myth of the perfectly informed social media trader. It turns out, investors who heavily use social media and follow these financial finfluencers, actually score significantly lower on objective investment knowledge tests compared to people who don't use social media for investing. Yet their subjective knowledge, meaning how confident they are in their own abilities, is way higher. This is a highly dangerous mix. Low actual knowledge plus extreme overconfidence creates incredibly predictable sentiment-driven market distortions. And the institutions know exactly how to exploit this. By 2034, the market for social media sentiment tools is projected to hit a mind-bending $21.7 billion. Think about that. Hedge funds aren't scared of Reddit anymore. They're deploying highly advanced AI and natural language processing algorithms to scan millions of social media posts in real time. They filter out the noise, detect sarcasm, and extract actionable trading signals before the retail crowd even finishes typing their posts. The smart money has literally weaponized the retail sentiment that used to catch them off guard. So, where does this leave you? Section 5, Strategies for Serious Investors. Let's talk about how you navigate a market dominated by algorithmic giants on one side and highly volatile crowds on the other. First things first, we need to completely redefine who the real smart money is today. According to compelling research highlighted by Acadian Asset Management, the true smart money isn't always the flashy hedge fund manager on Wall Street. It's the corporations themselves. Corporate insiders, the executives, the board members, possess the ultimate perfectly legal informational advantage over their own stock. When a company aggressively issues shares, they're essentially telling you the stock is overvalued. But when they execute massive share buybacks, or when insiders buy the stock with their own personal cash, that is the absolute purest signal of fundamental confidence you can find anywhere in the market. To distill all of this into a concrete playbook, we look to the evidence-based advice of researcher Larry Swedroe. For serious investors, the strategy is remarkably clear. Number 1, be incredibly humble about your stock picking abilities. Look, if institutions struggle to beat the market with multi-million-dollar supercomputers, you probably aren't going to do it consistently with a smartphone app. Number 2, follow those corporate insiders and buybacks. That is your real data edge. 3, ruthlessly ignore the finfluencer fads and all that social media noise. Remember, that data is already being harvested and traded against by Wall Street algos. And finally, embrace systematic, passive, and low-cost strategies for the absolute core of your portfolio.
Which brings us to our final thought for today's explainer. The market has structurally converged. The tools are completely different now, but Buffett's old enemies of wealth, fads, costs, and emotional trading, are just as dangerous as ever. So you really have to ask yourself, in a market driven by algorithmic sentiment and massive institutional dominance, are you systematically investing like the real smart money, or are you just following the crowd? Take a hard look at your portfolio this week. Thanks for joining us, and we will see you next time right here on the Capital Intelligence channel for more essential financial insights.